Hello and welcome back to this channel. This is Unfiltered Forex with me, Clement, and in this video, I'll be going over something I haven't talked about in a while, right? Interest rate expectations. Of course, these are interest rate expectations for what the market expects the Federal Reserve to do in the next couple of months. Here we are. This is the CME Fedwatch tool. And yeah, it's a table, as you can see, it's a table of interest rates expectations of the Federal Reserve rates, right? The target range rate. Currently, the current rate is between 525 to 550 basis points, like 5.5% is the upper limit. And so you can see that column is not here, completely out of the window. So what that means is the market is expecting a rate cut in the next meeting and no more, not another pause, right? The Fed is not likely to pause again. So that's what this table is showing. So this is meeting date, this is probabilities, as you know. And one thing you need to understand while looking at this table is that most of these expectations are not exactly reliable, especially these longer term ones. They're not reliable in such a significant way as you might think. Okay, so the ones I prefer to monitor closely is the expectation for the next meeting and the meeting after that. All these others, no. So this is for the September meeting and this is the November meeting. Okay, and as you can see currently, the majority of the market participants here are expecting a full 50 basis point cut, right? A 50 basis point cut is the general consensus here. And you can see this is the odds of 25 basis point cut, and it's not so different from this other one, right? In fact, in the past, over this past week, the probabilities have been shifting, right? Sometimes this is the one above 50, sometimes it's this one like now. And so there's been a lot of mixed sentiments coming in this week. I'm sure you remember what happened on Monday. There was a massive sell-off in the market due to the unwinding of the yen carry trade. And yeah, during that time, the market was expecting a 50 basis points cut. Like most of the market was expecting a 50 basis point cut. And then now, again, at the end of the day, at the end of that day, probabilities had shifted again. The majority was on the side of the 50s here. And then now, as you can see, so it's essentially like a tug of war between 50 and 25. Personally, if you ask me, I would tell you the Fed is likely to do 25 at this time since, yeah, there hasn't been, they want, I wouldn't think the Fed would get aggressive with rate cuts at this time, right? They're probably going to deliver a small one to start off the rate cutting cycle. Okay, so why am I looking at this, right? Because how these consensus is shifting is generally what's going to be reflected when you look at the chart, especially the dollar index and the USD pairs. That's what you're going to see this mixed sentiments over there. So quickly, I'll move on to the dollar index, and that's what we're going to look at. Yeah, here we are. Yeah, this is the dollar index, and as you can see, this is the hourly chart. And for Monday, yeah, this is where Monday began, around here. From Monday to currently where we are now, price has been generally flat since Tuesday. Trend higher, back lower, higher, lower. Essentially, price is since this Monday low, price is only making higher lows. See, after this point, there was this point, and then this point. In fact, this is an almost equal low, but it's still in the category of high low. And then here we are now. And then after this low, we made this high, and then this high, and then this higher high. So yeah, higher lows and higher highs. Probably this is looking more like a retracement to signify that the move is likely to continue going downwards, especially considering this massive impulse. Remember, this is the NFP report. This is the Friday of the NFP report. There was an unusually weak jobs report, and that's what caused this impulse, and likely what something else will come and add on to this sentiment, and the price is likely to continue this fall. If you look at it from a daily time frame, let me change. Yeah, this is cleaner. Yeah, if you look at it from a daily time frame, you can see the expectations. You can see the price action is kind of in sync with how interest rate expectations have been moving. All right. So this is on Wednesday last week, and that was when the Fed came and delivered a pause, and they were pretty dovish, saying, "Yeah, it's likely to have a rate cut in the September meeting." But yeah, the market was already expecting that. And then coming into Friday, now that's when even the rate cut expectations, like, they started to be a bit too optimistic. All right, like you've seen, the market now started pricing in a 50 basis points cut, not even 25, a 50 basis point cut after the jobs reports came out, right? And even on Monday, now after, what do you call it, the market crash that was seen on Monday, although brief, the market started expecting now an emergency cut, like in the month of August. In fact, at that time, you can see in the table of probabilities, let's go back here. You can see this is the September meeting, and we're currently in August. The last meeting was in July. So between July and September, those are 2 months worth of data. Okay, we have two NFPs and two employment reports and two inflation reports, the CPIs. So that's why immediately when the stock market was seen to be crashing this hard, and then on top of that, there was the weak jobs report that came out on Friday. Market participants were expecting an emergency rate cut at that time. Okay, an emergency rate cut in the month of August. That's why, if you look at the rate expectations for September, we're showing like the market expecting a 50 basis point cut by September, because there was there was that sentiment showing an emergency meeting the Fed would likely do in the month of August to deliver an emergency rate cut to kind of try and cool the situation that was around here on this Monday. Okay. But as you can see, this was just some temporary panic, and even prices back to the Friday closing price here on the dollar index. Even the stock market, if you decide to check, you're going to see the same, something similar. Okay, so about the long term expectation of where you can expect the dollar index to go, generally, if you would ask me, I would tell you this index is likely to trend higher. For what reason? You see, once the rate cuts begin, it now sets off another reaction. Okay. Oh, I hadn't even seen this, but you can see there was this low and then this higher low, and probably this is another one. So technically speaking, it's likely to go higher from this point. Higher, why? Now, talking fundamentally, when the Fed starts cutting rates, right? Right now, the dollar index is falling due to the highly anticipated rate cuts. So what's going to happen once the rate cuts actually start coming? People are going to move out of the stock market. People are going to move out of uh, out of the treasuries. People are going to move, and now they'll start holding cash, right? Like you saw, Warren Buffett is holding around $277 billion in cash, and yeah, that's the whole point of why you would expect the dollar to start rising again. Because once people start getting out of the stock market, like you had seen the crash on Monday, but not now. I'm not talking about a crash. I'm talking about when stocks now start cooling because they're pretty hot right now. We're at in the not in the all-time high territory, but yeah, we are still green on a year-to-date basis, so there's still some room to fall. And once market participants start ditching their stocks and start coming back into cash, at that time the dollar will start pumping again. And then another reason is as these other economies like the Eurozone, the UK, Canada, which is this other one, uh, New Zealand, Australia. Yeah, as these other economies start cutting their interest rates, that will make their currencies weak. And you can see due to how currency strength is determined and how these things are paired, the weakness of one is the strength of the other. So if these other currencies are going to be weakening, the dollar, of course, will be strengthening during that time. Okay, for that reason alone. So there are several factors at play here, and it's looking not too bearish for the dollar, right? Yeah, it might sell off again, but I think it's if it sells off, it's going to be temporary, and the dollar here is likely to rise again once the rate cuts now start coming. Okay, yeah. So that's it for this video. I don't have much to say. I'm sure you probably heard something interesting, and thanks for watching.